you can outperform the market. Let me ask you this question. At the end of the day, what is the S&P 500? It's just a basket of stocks. And if that's all it is, then outperforming is easier than you think. And oftentimes, dividend growth companies do outperform the market. The question I aim to answer today is, why is that? Put simply, they focus on organic growth. Some of the best dividend growth companies actually don't even focus on paying dividends. And I know it sounds pretty backwards, but think about it this way. When a company's main priority is focusing on their own growth, they're going to do better than companies that don't. Just look at Mr. Beast, for example. He's gone on record to say he puts pretty much 100% of his money that he makes from his videos back into the videos. And where's that gotten him? He's literally the #1 YouTuber on the entire platform. Hundreds of millions of views every single video. It's insane. His growth has been insane. The same can be said with companies whose top priority is to plow their cash right back into the business. If we look at United Health Group, according to Google AI Mode, their top 2 priorities when it comes to deploying their capital are ensuring financial strength and stability and reinvesting back into the company for organic growth. And as you can see, paying out dividends is still a priority for them, it's just last on the list. If we switch over to Seeking Alpha, we can see UNH has grown about 157% over the last 10 years, and that's including the dip. So it is below the S&P 500 right now over the last 10 years, but if we switch it to the max time frame, which goes back to about 1995, we're up 5,800%. If we go over to the S&P 500 over the last 10 years, like I said earlier, they've outpaced United Health. They're at 185%. But if we switch to the max and go to 1995, we are up a little over 1,000%. So basically, United Health Group has grown 5 times the amount that the S&P 500 has over the last 30 years. But okay, that was one example. Let's look at a couple others. Costco has been paying and growing their dividends for the past 20 consecutive years. And if we look at their chart, over the past 10 years, they're up 659%. And over the past 30 years, they're up 14,000%. 14,500 actually. Let's take a look at Lowe's. Lowe's is a dividend king. They've been paying and growing dividends for the past 61 years. And if we look at their chart, over the past 10 years, they're up 232%. And over the past 30 years, they're up 6,000%. Microsoft, same thing. They've been paying dividends for 21 years, growing dividends for 20 years. And if we look at their chart, they've seen phenomenal growth. Over the past 10 years, they're up 900%. And over the past 30 years, they're up 8,000%. Let's take a look at another example. Visa. They've been paying and growing their dividends for the past 16 consecutive years. And if we look at their chart, over the past 10 years, they're up 430%. Now, we don't have 30 years of time on this chart, but it does go back to 2008, and since then, we're up 2,000%. But okay, now you might say past performance isn't indicative of future results. I get that. So let's look at year to date. Year to date, S&P 500 is up 1.72%. Costco's up 16% year to date. Microsoft's up 10% year to date. Visa's up 16%. Lowe's is the only one that's down year to date. But the point of what I'm trying to say is it's still happening right now. Even if you missed the 14,000% price increase in Costco and you bought some at the beginning of this year, you'd still be beating the S&P 500 so far. But it doesn't stop there. Not only can dividend growth outperform the S&P during bull markets, they actually can outperform during bear markets as well. So I use ChatGPT to help me with the research on this section, and I'll link the websites that it cited, but I just want to read through this real quick. So from 2007 to 2009, the S&P 500 declined over 55%, while the S&P 500 Dividend Aristocrats Index fell only 47%. If you don't know what an aristocrat is, basically it's a company that's raised their dividend for 25 consecutive years. But not only did they lose less, they actually recovered to their pre-crisis levels 2 years earlier than the S&P 500. And that site's proshares.com. Let's take a look at another example. In Q4 2018, the S&P 500 dropped 19%, but the aristocrats only dropped 14%. The same thing as the last time. Not only did they drop less, but they rebounded quicker. The aristocrats got back to their pre-crisis levels by February in 2019, and the S&P 500 took until April, and that site's bristolgate.com. Next, it says that a study by Ned Davis Research found that since 1972, S&P 500 dividend-paying stocks outperformed non-payers by an average of 12.5% during bear markets, and that site's gurufocus.com. And also VIG, an ETF that tracks companies with at least 10 years of dividend growth, has showed lower volatility and better performance than SPY during market downturns, and that site's medium.com. So in short, beating the market isn't easy, but with dividend growth it's at least possible, and this is largely due to most dividend growth companies reinvesting their cash back into the business to grow. But not only that, they tend to outperform during bear markets as well, and they tend to be less volatile. And I didn't even touch on sequence risk, but they also can protect from that. I'll leave a link on sequence risk. I hope you got something out of this video. If you did, maybe consider commenting or subscribing. Anyways, I wish you good luck on your investing journey.